Okay, it's time to discuss bonds. Boring bonds, stodgy bonds, reliable bonds. And we start with a cute little joke about bonds. What's the difference between a man and a bond? The bond eventually matures. Right. Slide number 2. Okay. Investing in bonds. Well, what are bonds? Well, again, it's like stocks. It's an unfortunate term. They should just call the darn things what they are: loans. They're loans. You are loaning your money to the company, corporate bonds, the state and local municipality, muni bonds, municipal bonds. And what are we talking about? We're talking about states like the state of California, the city of Chula Vista, the Southwestern Community College, bridge authorities, water authorities, sometimes hospitals, nonprofit organizations that qualify as municipal entities, and of course the federal government, the Treasury, the granddaddy of them all. Bondholders receive interest on the loans, and the loan is repaid. We say the bond is redeemed or matures in 1, 10, 20, 30 years. Now, technically, anything below 10 years is called a note, but who cares? I call them bonds. Bondholders are first in line for repayment if there is default on the loans. Who's at the back? Stockholders. But of course, they got to pay any taxes and payroll expenses first before they pay the investors. Bond prices are less volatile than stocks, but they still fluctuate. What are you talking about? The loan? How can the price fly? Hang on a minute. The average return over decades has been anywhere from 2, 3 on the low side to 5, 6, 7, even up to 8% on the higher side, but those are more riskier bonds. Bonds are very good intermediate term, and they could be long-term investments for some people who are, kind of worried about the stock market. And there is a way for bonds to be short-term, but you learn about that in Business 123, Introduction to Investments. It's a little tricky, but it's not really that tricky. Uh, so that's investing in bonds. Now, why? Why do investors buy bonds? Well, for the most part, investors buy bonds for interest. They are income. They sometimes are called fixed income because we know when we buy the bond, unless anything goes wrong, the company goes into default or something like that, we know how much money we're going to get. We know we're going to get our interest payments, and then we're going to get the loan repaid at the end of the term when a bond matures. As we said, the face amount will be repaid at maturity, although there's always the risk of default, which is a fancy way of saying they ain't paying you. This is usually very, very small. If the risk is high, the bonds are usually referred to as non-investment grade bonds. That's the proper term. Most people call them junk. But, most people pay their credit cards, they pay their mortgages, they pay their car loans. The same thing is true for bonds. Every once in a while there's a problem, but for the most people make their payments. There is also the potential for the appreciation of the bond value. You may be able to sell your bond to someone else at a higher price if the current interest rate on your bond is higher than the current market rate. What do you talk? Relax. We'll get to that in a little bit. But yes, bond prices go up and down. And how is that happening? We'll discuss that. Why sell bonds? When an entity sells bonds, they are borrowing money. Well, usually the same reason that the companies and states and local governments and the federal government makes loans is the same reason that you and I make loans: to operate, to expand, build a new factory, move into a new country, build new or upgrade older schools, bridges, finance a war, big ticket items. You're going to get much better rates than if you went to a bank or other money lending entity. And sometimes the bond issuer just can't go to a bank. Can you imagine the federal government asking your local credit union for a $900 billion loan to invade Iraq? Almost every election year in California, the voters are asked to approve a bond proposition. Parks, schools, water projects, transportation, emergency and public safety equipment. The state of California then sells the bonds to pay for the project and must pay the interest and pay back the principal over 20, 30, or usually about 30 years. Do you believe that most voters understand what they're voting for when they, yeah, it sounds great, we want new fire equipment, the bullet train, people don't realize that you got to pay that money back with interest. And where did the money come from? Our taxes, of course. And in the case where the bond issuer is a corporation, sometimes it is difficult, not advantageous, or simply impossible to sell stock. I mean, you'd rather sell stock, right? Because you don't have to pay it back, and you dilute your earnings. Maybe you dilute your ownership, but still, you get the money. The interest is a tax-deductible expense. Well, that's one good thing about bonds for corporations. Whereas dividends, the stockholders are not tax deductible, and so sometimes the bond issuer would rather make a loan than sell more shares of the stock. And sometimes the companies are trying to take advantage of what is called financial leverage. You hear people say you're going to use other people's money to make your money. That's called leverage. And we'll see that in action when we take a look at real estate. Real estate is where you really use financial leverage. Bonds are debt financing. Corporations, municipalities, or the federal government borrow for many of the same reasons that individuals borrow, to finance their operations. Stocks, on the other hand, are equity financing, ownership. A corporation is selling a piece of itself to finance the operations of the company, whereas the government, can't sell a piece of the government. It's a sovereign entity. It's sometimes called. So Chula Vista might be able to sell land that they owned, but they can't sell Chula Vista itself, right? Yeah, Southwestern College, for decades, the developers were just their mouths were watering over that corner of the H Street and Otay Lakes Road, and every every month, or the superintendent president would get calls from developers trying to turn it into a shopping center. Well, they almost did too. They almost turned it into a shopping center about 15, 20 years ago or so. But the governing board, thankfully, did not sell the land, and now we have a very ugly. I mean, the new Performing Arts Center. Yeah, we got another onion for that. We got an architectural onion for the Math and Science Center, which the first time I saw it, I just said, "Look, it looks like a prison. What are those bars doing?" And when we finally got a chance to talk to one of the architects, those are curtains. I said, they look like bars. I taught it at Donovan Prison. The buildings there are better looking than that. Of course, they got an architectural onion for that one, and they got an architectural onion for the Performing Arts Center. Ugh. Oh, well. The old buildings were so beautiful, and they're disappearing. Let's go. Slide number 6. Characteristics of bonds. Written pledge to repay a specified amount. It's like a mortgage, right? There's a face amount, also called the face value, the par value, and you're going to pay interest along the way. Now, typically bonds are denominated in $1,000 increments. There are some that are $5,000 and $10,000, but for our purposes, all bonds will be $1,000. Bondholders receive interest every typically 6 months, although some bonds pay quarterly and monthly, but we're going to stick with 6 months. And the legal conditions are described in the bond indenture. That's a fancy word for the mortgage documents. Those are the agreements that you make when you make loans, as if you're a corporation or a state and local government or the federal government. And there's a trustee that oversees the bondholders' interest. For example, the Southwestern has gone to the voters a few times over the last 20 years and asked for bond issues. They asked for the voters to approve bond issues. And in the indenture, in the contract, we said, look, we're going to use this money to fix up the old buildings and build new buildings, the stadium. We didn't, that new stadium, I mean, it was not that new anymore. I'm getting old. But we didn't hold a bake sale to build that stadium. It was tens of millions of dollars. So we had to agree that we're going to have trustees watch over and make sure we don't, throw a party for ourselves, give ourselves raises or whatever. And that was in the bond indenture. Now, what are the types of bonds? Well, there are secured bonds and unsecured bonds. Sounds familiar, right? When we get a mortgage or a car loan, the loan is backed by that asset, and that's why they're called mortgage-backed bonds. The bond is secured by various assets of the issuing firm, just like a homeowner's home mortgage. If the bond issuer does not pay, the asset is seized. And these assets are huge, planes and railroads and of course now mortgages. They take those mortgages that we make to buy our homes and they package them into these huge bond issues and sell them all around the world. And that's one of the big things that got us in trouble in the global financial crisis in the 2000s. Then there are debentures, and I can never remember exactly how to say it. Debentures. These are unsecured bonds, and most bonds are unsecured, like credit cards. If the bond issuer doesn't pay, the bond investors must go after whatever assets or income they can find. So the mortgage-backed bonds exactly are going to have a little less of a interest rate because they're not little less risky than the unsecured debentures. And then there are convertible bonds. Ooh, doesn't that sound sexy? A convertible bond? Driving down the road with the hair blowing through your wind or whatever, wind blowing through your hair. Well, yeah, they usually don't turn out so well. Just like that convertible that all of a sudden the top won't go down, top won't go up when it's raining or whatever. So yeah, convertible bonds don't usually turn out to be as exciting as they sound to be, but they can be converted into stock. And so think about it. If you own the stock, you're part owner, and if the company does really, really well, the stock's going to do really, really well. When you're a bond owner, well, oh well, your company does really well, you're still going to get your interest payments and your principal back. So a convertible bond allows us to participate in any potential, and it's only there, potential success that the company may have. Now, what are the call features of bonds? Well, this is something that we have a corollary to. We have something that we can think of it. When we make a loan, or a car loan, or mostly a mortgage, and then interest rates fall, wouldn't we like to turn around and refinance that loan? The same thing is true for bonds. Corporations and municipalities can sometimes call in, come here, bonds, come on, bonds. They buy back the outstanding bonds from current bondholders before the maturity dates. Now, the Treasury, the federal bonds, the government bonds, they've never been issued as callable. Doesn't mean they won't be in the future, but they just never have. But most agree not to call in their bonds for the first 5 to 10 years after they're issued. It's called a deferred call period or a call protection period. And you're going to see this when you take a look at the examples, the Capistrano School District and the Poway School District. Bonds are called in if the interest rates they are paying is higher than the going rates. It's the same idea as when a homeowner refinances his or her home mortgage loan. You want to take advantage of lower rates. But the bond investor is not happy about this. So obviously, non-callable bonds are going to be a little bit more attractive and desirable than callable bonds. And hence, non-callable bonds will typically have lower interest rates than callable bonds. Yeah, risk versus return. Yeah, exactly. Slide number 9. Bond interest is normally taxed at your marginal tax rate. Remember that thing we talked about way back in chapter 3? This is always true of corporate bonds. However, municipal bonds are not subject to federal income taxes, and federal bonds are not subject to state income taxes. Now, this is part of the Constitution that says the states can't tax the feds and the feds can't tax the states. This is a very important feature for wealthy investors, and you must look at the taxable equivalent yield. And we're going to learn how to calculate it. Some muni bonds are double tax-free. IRS doesn't like that. They like double tax exempt, okay? They just don't use free with the IRS. Anyway, if they're from your state, your state will say, okay, we'll exempt you from the state income taxes. So if we buy a bond, we're in California, we buy a California bond, doesn't matter where it is, up and down the states, doesn't matter. As long as it's domiciled in the state of California, then when we do our income taxes, we don't have to pay income tax on the feds. Well, we always don't have to do that for any municipal bond, but we also don't have to pay state income tax on the state, from the state of California on that interest, because it's a way of sweetening the deal. Hey, you're a California resident, buy our bonds, and we won't tax you on the interest. But be careful. Some bonds are subject to the AMT. I don't know how the Congress got around this, but they did. The alternative minimum tax. We talked about that back in chapter 3. And the interest from those municipal bonds is no longer exempt from federal income taxes. So just be careful. But these are people who usually are making a lot of money, so hopefully they got a competent broker and tax advisor that will find for them bonds that are not subject to the alternative minimum tax. Okay, so here's the taxable equivalent yield. This is going to look strangely familiar. You wanted to forget all about the federal marginal tax rate, but I told you it was going to come back and bite you. Whatever yield we're getting, the tax-exempt yield, don't use the term tax-free, IRS doesn't like that, and you then divide it by 1, which is 100%, minus whatever the marginal tax rate is. So if you're getting a bond at 6%, but it is federal tax-exempt, and you're in a 25% tax bracket, what is your taxable equivalent yield? Well, you take the 6%, 0.06, make sure you understand that. If not, give me a call. Divided by 1.0 minus 0.25. At 25%, that's 0.25. And that's 0.75. So 0.06 divided by 0.75 is 8%. Now, what does that mean? That means you have to go out and get a fully taxable 8% bond, corporate bond is a figure, that is equivalent to this 6% bond. Well, wait a minute, I don't understand. The 8% bond is only paying us $80, that's 8% of 1,000, whereas the 6% bond is paying us $60, right? Because that's 6% of $1,000, that's how it works. But wait a minute, that 8% bond is subject to income taxes, and if we're in the 25% tax bracket, that means we got to give 25% of that $80, which is $20, to the feds. That's why it is called the taxable equivalent yield. I know it sounds, highfalutin, but it really just makes sense. It means, hey, we have to go out and get a bond paying at least 8% to be equivalent to this 6% tax-exempt bond. And then if we are in the state of California, we have to add our state marginal tax bracket. So, excuse me. Excuse me. So if that same 6% bond was both federal and state tax exempt, it was based here in the state of California for those of us in California, then we would say we're in the 25% Fed bracket, 8% state bracket. Remember, these brackets are really not, it depends on your bracket. So 6%, 0.06 divided by 1 minus, and then we have to add the two together before we do the subtraction. 0.25 plus 0.08 is 0.33. 0.67, 1 minus 0.33 is 0.67. So we would take 0.06 divided by 0.67, and we get 0.895, which is, 0.0895. My apologies, that would be 89%. No, sorry. 0.0895 or 8.95%. So you see, these municipal bonds are very popular with people in higher tax brackets because they're worth more to them. And that's why people typically who buy muni bonds are usually pretty well off. Plus, you're going to see they want $25,000 minimum. Yeah. And I remember when one of the bond issues was on the ballot here in Southwestern, and the governing board member was saying we need to educate the people here in the South Bay so they can invest in Southwestern College. And I was in the back of the room, and I wasn't going to burst his bubble. I was going to say, maybe, believe it or not, Coronado is in the Southwestern Community College District. But no, maybe some folks in Bonita, but no, who's going to, right, Rancho Santa Fe, Del Mar, La Jolla, right, La Jolla, those are the places in Beverly Hills, and like people with very high income and high net worth, high income are the people who buy muni bonds, typically, very popular. And as we said, they want, $25, $50, $100,000 minimums. You'll see that when you see the advertisement for the Poway School District bonds. Now, making the decision to buy or sell a bond. Can the corporation, the municipality, or the federal government pay back the face value at maturity? Will you receive your interest payments until maturity? So in many ways, you are like the bank, right? You have to start thinking like a bank. Can they pay this loan? We're going to give them this money. Are they going to walk away with it and say, sorry, we can't pay? Sometimes they do. One person who wants to be president again did this many times. Right? He's very proud of taking all the assets away from the corporation, putting them somewhere else, and then declaring bankruptcy. Anyway, what's the bonds rating? Well, they don't use a numeric score like we do on our credit rating. They start with AAA being the gilded edge, they call it. AA, triple B, double B, B, triple C, double C, C, and then D for default. There's no F. Anything below triple B is called non-investment grade. So triple A, double AA, triple B, those are all investment grade. Once you get below triple B, that's called non-investment grade, but what do people usually call it? Junk bonds or distressed bonds or speculative bonds. And when you look at the presentation on Ford, you're going to see that Ford was downgraded to triple C, which is pretty darn bad. You can think of these things like the idiot lights on your car's dashboard. It used to be that those things were useless. Now, my understanding, I'm not a motor head. I don't even like cars, but you got to get around. I like my bicycle and my motor scooter. Once you see the oil light go on 30, 40 years ago, just keep driving. You only got a couple more minutes before the engine seizes. But now, as soon as you see it, don't listen to me. I don't know what I'm talking about. As soon as you see that oil light going, pull over, right? Call the mechanic. And this is the same thing is true here. Once they bring it down to C or D, it's too late. They didn't downgrade Enron, which you guys don't even, you weren't even, some of you weren't even born yet. But they didn't downgrade Enron to a non-investment grade below BBB until they were practically in bankruptcy. So these rating agencies, Standard & Poor's, you've heard of the S&P 500, right? Standard & Poor's, Moody's, Fitch's, they were called to task after the 2002 crises with Enron and WorldCom and Global Crossing and Tyco. And they then screwed up big time again in 2007 and 8 when they were giving AAA ratings to these mortgage-backed bonds that were backed by loans, mortgages that people didn't even have to show how much money they made. They were called liar loans. And yeah, that's one of the biggest contributions to the global financial crisis was these imbeciles who are paid very good sums of money. And when they were called before Congress, they said, well, we did the best we can. Yeah, right, buddy. Because they have a really, really advantageous position in our economy. They can rate these agencies And then if they make a bad call, they can't get sued. Right. Or if you and I did that and we made a bad call, we could get sued. Yeah. Now, it's time to take just a quick couple breaths, because this is the trickiest part of bonds here. Bonds and interest rates. There's an inverse relationship. You see that seesaw? Keep that seesaw in your mind. That will really help you. It helps me. As interest rates fall, bond prices rise. As interest rates rise, bond prices fall. Now you may be thinking, wait a minute, the bond is set at $1,000. How can it change prices? Well, yes, the bond started out at 1,000, but the only thing that is fixed with regard to the bond is the interest rate. The price is not fixed. It could go up or down. Remember, these are securities, which is a fancy way of saying you can buy and sell the financial investments. Since the interest rate of your bond does not change because the interest rate is fixed, we call bonds fixed investments. Because that can't change, the price of the bond changes to reflect the change in interest rates within the financial industry, because the price of the bond is not fixed. This is a great source of confusion and consternation. You like that word, consternation? To many in and out of the investment world. It just drives people nuts. Because wait a minute, how can a loan change? Well, yeah, the interest rate doesn't change, so the price does change. So let's see an example here on slide 14. Say your bond is paying 10%, and this is back in the 1980s. The bond's value is $1,000. Now that's the par value. That's the face value. That's what it was sold for when it was issued, and that's what you're going to get back when it's redeemed. You're going to get $1,000 back. But let's say interest rates. So that means you're going to get $100. That's how it works, right? 10% bond gives you $100. 5% bond gives you $50. 1% bond gives you $10. That's how it works, right? $1,000. 10% of 1,000 is 100. Actually, you get that twice a year. You get half of that, $50 twice a year. But no, don't worry about that. Now, what if interest rates fall to 5%? Wow, a new bond is only paying us $50. Investors have to pay $2,000 to get the same amount of interest. To get $100 worth of interest, they're going to have to buy two $1,000 bonds. So would you sell your $1,000 bond that's paying 10% when other bonds are only paying 5%? You're getting $100, they're getting $50 a year? No, you would demand a premium. The result is your bond is now worth more than it was. You would have a capital gain if sold. The bond could be sold at a high premium. Now, is it going to go to $2,000? No, it doesn't work that way. Because when the bond matures, you're only going to get $1,000 back. But if that happened, if interest rates went from 10, and they did, between the 1980s and the 2000s, your bond would be worth a lot more money, $1,500, $1,600, depending on how much time there is until it matures. It's not a linear scale. It doesn't go in a straight line. And we learn more about that in the Business 123 Introduction to Investments class. Okay, now what happens when the reverse happens? You bought a bond that's paying 5%. You're getting $50 a year, $25 twice a year. And interest rates now rise to 10%. Now, with a 10% bond, they're getting $100 a year. Right, they're not going to buy your raggy old bond that's only paying $50 a year. They're going to demand a discount if you wanted to sell. Now, you don't have to sell in either case. You don't have to sell if interest rates fall. You don't have to sell if interest rates rise. But if your bond was paying 5%, interest rates rose to 10%, your bond is now worth far less than it was. And if you sold it, you would have a capital loss. Remember, interest rates rise, bond prices fall. It's that seesaw effect. So do your best to remember that picture in your head. It really helps me. Okay, so let's do bond pricing problem number 1. Juan upon a time bought a corporate bond paying 8% 4 years ago. But now corporate bonds like his are paying 6%. Would Juan be able to sell his bond for more than he paid for it, less than he paid for it, or the same amount? he would be able to sell it for more than he paid for it. If interest rates go down, bond prices go up. Now, he doesn't have to, but he could sell the bond at a premium. And then the opposite. El Coco bought a treasury bond paying 5% 2 years ago. Today, treasury bonds are paying 7%. Would Senor Coco be able to sell his bond for more than he paid for it, less than he paid for it, or the same amount? Because interest rates have risen, his bond is now worth less. The bond would sell at a discount. He doesn't have to sell it. He can hold on to it until it matures. Then he will get his $1,000 back. But if he were to sell it, if he were forced to sell it for whatever reason, he would have a loss. And a 2% drop is a pretty big drop, folks, or rise. A 2% change in interest rates is it depends on how long to maturity. The farther it is to maturity, the bigger the rise or the fall will be in the price. And again, we'll worry about that in the next class. Okay, the relationship of bonds and interest rates is why a bond will have different quoted rates. The nominal rate, that means named, the rate that the bond is paying. It's also called the coupon rate. What the hell? Yeah, well, you're going to hear that. And the reason is because bonds, many years ago, used to be documents that people traded, and they had coupons attached to the document. And when the interest was due, you would cut out the coupon and send it in with your name and address to the company or the state or whatever, and they would turn around and send you a check. And they don't do that anymore. It's all electronic. Now, the current yield, though, is the true rate of interest that the bond is paying, since it reflects the premium or the discount price that the buyer had to pay. The yield to maturity is the yield you would receive if you were to hold on to the bond until it matures. So there's three rates we have to worry about. The named rate, that doesn't change, 7%, 5%, whatever it was at the beginning, that's what it'll be until the bond matures. But then depending on it, whether it's a premium or a discount bond, the current rate and the yield to maturity will be different. Now, if they're all the same, that means the bond is selling at par. That's the word we use. Par value. There's no premium. There's no discount. So it'll be selling at 1,000. So all three of them would be the same. So now here's the calculation for a current yield, the current percentage. You take the dollar amount of the annual interest, that doesn't change, and then you divide it by whatever the market value is. So, for example, if it's a 6% bond, $60. Now, don't put 0.06, okay? Don't put 6 cents. That's if it were a dollar bond. And that's what people, when they do these problems, they don't listen to the presentation or what, do the worksheet, and then they go, I can take the exam without doing the worksheet, and they put 6 cents. And then you get a sopapo, dope slap. So it's a 6% bond, but it's selling at $1,100. So $60 divided by 1,100 means you're only really getting, at this moment, 5.45%. A bond selling at a premium has a current yield lower than its stated rate. Okay, you're going to see this when you go through the presentations of forward bonds and the Poway bonds. You're going to see that the current yield goes up and down as and the yield to maturity, as we're going to see in a couple subsequent slides, it goes up and down also. So if you buy it at premium, you're not getting the 6%. You had to pay $1,100 to get that $60, so you're really only getting 5.45%. But if you buy it at a discount on slide 20, say the bond were only $900 in the marketplace, then you're going to get a yield higher than the coupon rate, the nominal rate. $60 divided by $900 is 6.67%. So you see, we don't have to pay $1,000 to get that $60, so we're really getting more than 6%. We're getting 6.67%. Okay. Paquito, es tan difícil, as my students at San Isidro used to yell at me when I taught business math there. No, it's actually very similar to the one we just did. We just added a few things to take into account the fact that we're not going to get what we paid for the bond when it matures. See, the yield to maturity says, you know what? You might have paid $1,100 or you might have paid $900, but when the bond matures, you're going to get $1,000 back. So it's really the previous formula with a few things added in. Here's the annual interest. Remember, 6% bond is going to pay us $60. And then instead of dividing, I like to do the bottom first because I just think it's easier. Instead of dividing by the market value, we divide by the average of the face value, the par value, what we're going to get back when the bond matures, and the market value. So how do you average two numbers? You add them together and divide by 2. So that's what that is, right? The bottom quantity is just the average of the face value and the market value. Well, what's this bad puppy up here? And people say, why do you add down here? Why do you subtract up here? Well, there are two different calculations. The bottom is the average of the par value, face value. They mean the same thing. Always 1,000 in our class. Remember, some bonds are 5,000, 10,000, but we're only going to use 1,000. So the face value and the market value divided by 2, that's the average. But over here, this quantity here, face value minus market value divided by a number of periods, and I really should put parentheses around this whole thing, because you got to do this first before you add the interest, okay? Make sure you do this whole thing first. Subtract, then divide, then add, then do the bottom, or do the bottom. I do the bottom first, and then finally do that division. What are we doing here? The top quantity takes into account the appreciation or depreciation of the bond. Remember, we paid, in this case, the $900 bond. We paid $900 for it. But we're going to get $1,000 back when the bond matures. That's a cool deal, right? So what are we going to do? We're going to say, look, every year for the next 10 years, we'll take 1,000 minus 900, that's $100, and then we're going to divide that by 10 years. So that means every year for the next 10 years, we're going to get an additional $10. Now, we don't get that. Nobody sends us a check for that. Nobody sends us $10. But the bond price is going to go closer and closer and closer and closer back to finally when it hits 1,000. Now, it doesn't happen linearly. It's not a straight line. But this is an approximation. Okay, close enough. We are going to get basically an extra $10 a year until the bond becomes 1,000. The same thing is true if it's a premium bond. We have to come from the premium price down to 1,000. So that 6% bond that was paying us, where's my mouse? There it is. That 6% bond that was paying us 6.6% currently, if we hold it for the 10 years until it matures, we're actually going to get 7.4%. Cool, because we're going to get $1,000. We're going to get an extra $100 when it matures. And so let's now. I'm sorry, I'm getting ahead of myself. Now in the face-to-face class, we would stop and do the worksheets in the chapter 13. Because they're going to be on the exam. And look, don't worry about it. It's math. No, it's arithmetic, folks. It's not math. Math is when the numbers disappear and you start putting silly symbols like epsilon and rho and theta and x and y. But just do your best and don't worry about being perfect. We're not grading you on this as a math whiz. We just want you to understand that bonds. It's the one thing that people really don't understand, that bond prices go up and down and that relationship of interest rates. And why is it true? Well, it's because it's money. And we're not very fuzzy when it comes to money. We want to know how much we're getting. We want to know how much we're paying and how much we're getting for what we paid. Okay, so now let's take a look at where we buy bonds. Well, as we've intimated, as we've mentioned, most small investors don't participate in the bond markets, right? Bond traders normally deal in the millions of dollars. They want you to pony up at least $25,000, preferably $100,000 or more. And you're going to see this again when you see the Poway bonds and the Capistrano bonds. You're going to see that they $25,000 minimum, go away if you don't have that much money. The major exceptions, though, are federal treasury bonds, government bonds. Why? Because the small investor is welcome at treasurydirect.gov, which is actually a very cool website, folks. The Mexican government basically copied it. I had the good fortune of meeting the project manager. He said, "Oh yeah, we just we just stole from you guys," and so that's our first assignment. One of our first assignments in the Business 123 Introduction to Investments class is to learn how to use TreasuryDirect.gov, and it became very popular a few years ago, when inflation was taking effect, and the Treasury bills, the inflation-protected Treasury bills, were paying 9%, which is pretty darn good. But that was only for not even a year. So when you are very wealthy and they come out, the bonds come out they're newly issued. You're going to buy them from an investment bank or from a company representative or your broker. Mostly your broker is going to do it because you're very wealthy and your private broker is going to handle this. But again, at treasurydirect.gov, everyone is welcome. You got $1,000, you can buy a bond for the same price that the big boys and girls on Wall Street pay. Once the bond is out there, then you have to find another investor who's going to sell theirs. And you pay a commission, and you typically have to go through a broker. But the reality is people buy bonds for income. Mostly, there are bond traders and speculators, but most people just hang on to their bonds. They buy them for the interest, and then they're redeemed at the end. So most small investors are better served by investing in a bond mutual fund. What? Yeah, we've already made mention of these guys, and that's the subject of our next chapter. We little people love investments for the masses, and that's what mutual funds are. You get professional money management and diversification. Bond traders are used to buying and selling in the millions, smallest transactions are tens of thousands. The mutual fund managers, the pension fund managers, the life insurance companies, they have millions of dollars to invest, so they get a much better deal because of their size. Although it is very easy to buy treasury bonds and bills and notes. They all, the bills are a little different, but the treasury bonds and notes are very similar from the federal government at treasurydirect.gov. So what's the bottom line on bonds? Bonds are good intermediate term investments, folks. And for those people who are having trouble at night sleeping, if they're fully invested in stocks, bonds are decent long-term investments. But for the long term, folks, I hope if you've seen that stocks really are something that we should consider when we have a 10, 20, 30-year time horizon. But some people are just really frightened. So, okay, I'll stick with my bonds and get 5-6%. But as you're going to see when you look at the hypothetical illustration in Chapter 13, bonds just don't give us that growth element. Whereas stocks, hopefully you went through the hypothetical illustrations in Chapter 12, and you saw that stocks are very, very what's the word? They're very advantageous, very good to us. Been very good to me, very good to me. My stocks have been very good to me over long term. In the short term, they can give you a heart attack, right? Bonds won't do that. Bonds won't do that. So do you want to eat well or do you want to sleep well? But don't be fooled. Bonds have risks too, especially when interest rates are very low. In 2022, many bondholders were just shocked when the bonds as a whole went down 13%, I think, in 2022. Why? Because interest rates rose. Right. Interest rates rise, bond prices rose. Right. Bond prices fall. I'm sorry, listen to me. Interest rates rise, bond prices fall. And so what happened is they were used to getting their interest, and then bond interest rates kept falling. So, hey, my bonds are worth a little bit more. And that had been going on since the 1980s. Interest rates falling. And every once in a while bumping up, but basically in going down until 2022 when inflation picked up because of that stupid microbe COVID, and people were shocked. But a 13% drop in stocks, that's nothing. So it gets back to that old saying, do you want to eat well or do you want to sleep well? And what we're going to see in our next chapter when we go through mutual funds, we're going to see some hypothetical illustrations where we use a balance of stocks and bonds. And oh my goodness, it can help us eat reasonably well and sleep reasonably well. So you see, I'm getting a little excited now because bonds are kind of boring. But when we get to mutual funds in our next chapter, investments for the masses, you're going to find that, yeah, there's a way that we can eat reasonably well and sleep reasonably well. Thank you so much for being in our class. Make sure you go through the worksheets. The worksheet in chapter 13, there's an answer key and a commentary, and we want you to be awesome. And we're going to go through them, and you're going to do well. And even if you don't do that well on the exam, don't worry about it, all right? Just do the best you can, and you'll be amazed at how much credit you get, because I was a math major in my undergrad years, and we lived and died by partial credit. Thank you so much for being in our class. We are so proud of you, dear students.